Is a recession on the way? And if so, what are the top 5 things that you need to do to be financially prepared?
The biggest downside risk in a recession is not about your investments going down, it's about you losing your job. So invest in yourself, invest in your skills, and always stay relevant. And that's the safest sort of investment to make in any kind of economy.
Next, pay off high-interest loans and credit facilities. Interest rates for credit cards, for example, can range between 20% and 26% per annum. Additionally, late payments will result in high interest charges. Compounded daily, these charges can easily snowball.
You want to take stock of what sort of loans, what sort of debt you have outstanding. It's always wise to pay off the higher interest rate debts first, and then after that you pay off the lower interest rates. You know, at the end of the day, all these interest rates will actually start eating into your cash pile, and that's the last thing you want.
During uncertain times, access to liquidity is especially important. So this is a good time to take stock of your savings and expenses.
You want to be able to plan your spending. I think it's always wise to, if let's say for me personally, right, on average, how much do I spend on food, on transport? What are the regular bills that I need to pay when it comes to housing, electricity, water bills? So these are the kind of things that you can actually set aside and you can actually plan for. There'll be the other side of things where you also want to have enough money to, say, invest into the markets when the markets are really weak in times of recession.
It's financially prudent to have an emergency fund to cover your expenses. 6 months is a recommended minimum, but you may wish to consider having a bigger buffer.
I would say I'm looking at around for 8 to 10 months. It's more from a mental health perspective. Having 6 months of spare cash, you probably take 1 month, 2 months max to sort of rest and resettle, reframe your mind, re-strategize where you want to look for jobs, where you want to try to reapply. That's 2 months down. So you have about 4 months of spare cash left. And then if let's say you are going to look for a job. Now, it's not always easy that when you send out application, the HR will get back to you. By and large, you're maybe eating it already into your 5th month out of your 6 month reserve. And when you're coming to the tail end of that reserve, you tend to be a bit more flustered, a bit more stressed.
If you have enough spare cash, consider buying short-duration bonds that will help you earn interest for your other short-term spending needs.
If let's say I do have that spare cash lying around, I have need for cash, but it's not an immediate need, definitely short-term bond funds would make sense. I would not recommend fixed deposit. Reason because your money is actually locked in there for 3 months, 6 months, 1 year, depending on the terms and conditions that's set out by the banks, right? So when your money is locked into the fixed deposit, you immediately lose that liquidity factor. Short-term bond funds, it makes sense, but it's going to be a bit complicated because you want to look for the higher percentage, the higher yield, the higher returns, and then every time when the bond matures, you want to roll it over.
Next, make sure you have the right insurance policies to tide you through any unexpected events.
You need to get insurance. Insurance is to help you to protect your wealth because you don't want to be in the situation where you get caught with medical expenses, right? So sometimes these are the things that really are unexpected. So you want to make sure that you are well covered for your hospitalization, critical illness, right? And if you have a life policy, that will be even better as compared to buying a mortgage insurance, which tend to be more expensive, right? So for insurance journey, I would recommend people to look at term insurance rather than long-term insurance.
Term insurance covers a specific period. It pays out only upon death or total and permanent disability and does not build cash value. It's generally more affordable than whole life insurance, which offers lifetime coverage and builds cash value. Now may also be a good time to assess and prioritize your policies.
I think while insurance at the basic level is important and it's good, Not all insurance is necessary. It doesn't make sense to pay increasing premiums just because you want that private hospital bed, so to say, right? Is this level of premium something that is really necessary for me? Can't I get access to the same care of maybe same quality at another hospital, at a government-aided hospital, so to say? For example, if an individual is really cash-strapped, right? But he or she has a car, for example, but our transport infrastructure is really good. If there is no real need, you may want to maybe sell off the car and cut off the car insurance. And that actually translates to quite a lot of savings.
If you own stocks as part of your long-term investment strategy, analysts say don't sell when prices are falling. A short-term downturn in the stock market is unlikely to have a material effect on your long-term plans.
You're always going to be surprised by why the downturn is coming. But the fact of the matter is you should always be prepared for a downturn. I mean, selling low and buying high is never a good plan. Let's assume that you fear that the next few years are going to be pretty bad for the markets. Even then, it's imperative for you to stay the course. Maybe reduce your incremental investment. Maybe you have a regular investment plan. Maybe next month you allocate more to fixed income. You allocate more to money market funds if you need be, or allocate more to gold. But do not change your investment plan dramatically on the back of one-off incident, no matter how massive the one-off incident is.
During the 2020 pandemic crash, it took the S&P 500 just 4 months to return to record highs. While it's impossible to predict where markets will be headed in 2025, experts advise investing in companies with good fundamentals.
So a lot of time, if you invest in good business, you hold it and then last through the cycles, usually these businesses will grow their earnings over time, especially if they have pricing power, they have good economic moats, right? They should continue to grow over time, right? And even after the crisis, they would come out stronger, right? I think we've seen that during COVID, when a lot of businesses, like some of the good quality businesses, if you own them, they actually come out stronger and the share price recovered, right? So Singapore Bank is some of those examples where I think you see the share price today have gone up so much.
Consider defense and utilities names that fare reasonably during a recession.
It's going to be very difficult to find bright spots in a recession, but to the extent that you have to find, fixed income, defense and utilities. I mean, you got to avoid the growth names, which is basically consumer discretionary stocks and your big AI and tech companies, because their valuation is already inflated. Plus, there's going to be a growth slowdown, and that's a double whammy. You get squeezed on both sides.
Healthcare, infrastructure, and transportation are some sectors that may do well in good times and bad.
I will try to keep at least 20 to 30% of my portfolio in cash, which I can take advantage whenever any of the companies that I have in my portfolio comes down in terms of valuation. I might add on onto those positions because those are generally a good time to buy more good quality businesses, right? So, and we also like to look at the businesses that are going to do well in good time and bad time, even if there's a recession. Okay, so companies like your healthcare related stocks, infrastructures, transportation business, generally these are the businesses that should continue to do well in good time or bad time.